Hi, I'm Grant Stephen, one of the two investment guys. Chris is away this week, but I have with me a very special guest in Dr. Warren Jestin, who is Senior Vice President and Chief Economist for the Scotiabank, whose team is responsible for very in-depth analysis of various global economic factors. Warren, thank you for joining me today. I wanted to start by asking you, your team recently revised their expectations lower for the Canadian economy, and I was wondering if you could give us your new outlook.
Sure. I mean, we see growth continuing. We don't see economic decline on the horizon, but what we are cognizant of is what's happening in the U.S. We've got a lot of volatility in financial markets. There's a lot of angst in Europe, and all of those things tend to take confidence down. So in Canada this year, we're probably going to have about 2% growth, and I don't think it's going to speed up a whole lot next year. May do slightly better than in the U.S., but within Canada, there's going to be a difference. So if you're looking at the stronger provinces, BC, Alberta, Saskatchewan, and Newfoundland, and you can guess by that it's a commodity story and it's a gateway story because the strong markets are really offshore.
Right. Chris and I talk quite regularly about many of the macroeconomic factors, and I wanted to ask you what you consider some of the most important indicators that you watch.
Well, if you're looking at forward-looking indicators, confidence measures, consumer confidence, investor confidence, business confidence, always give you a guide. One of the reasons why people are reducing forecasts is because European and U.S. confidence began to decline in July and August. If you're looking at solid data, things that really matter to the consumer, employment, there's nothing more important than jobs to keep retail spending strong. And the good news, of course, is Canadian employment may be slowing in growth and maybe much more modest than in the past, but it's at record levels. And when you've got a relatively healthy job market, and of course the housing market helps too, you tend to have people much more willing to spend than otherwise.
Right. Now, quite recently, Mark Carney, the Governor of the Bank of Canada, indicated that he would be standing pat on any interest rate increases in the near term for sure. And I just wanted to gauge how you would read that. What does that say in the tea leaves to you?
Well, it started off with Ben Bernanke in the U.S., the head of the Federal Reserve, saying he wasn't going to raise interest rates probably until 2013, which is a long way away. Carney has indicated that in the current economic circumstances, he's not going to raise rates. I think what it'll translate into is rates staying pretty well where they are for the next year or more. And that means if you've got a variable rate mortgage, prime-based lending, those rates are probably not going to go up. However, if you're an investor and you're looking for higher yields on GICs, government bonds, and things like that, that also means that there's not a whole lot upside in the next year.
Right. I've read quite a bit recently that there's many challenging macroeconomic factors out there right now, but it seems to me that an awful lot of the corporate balance sheet stories that are coming in are positive yet cautious, and I wondered if you could speak to that a little bit.
Yeah, if you look in the U.S., Canada, Europe, corporations are probably as strong as I can remember them with their balance sheets and with retained earnings. They're effectively very, very flush with cash. The big issue, of course, is with all the nervousness in the markets, they're not deploying the cash in terms of expansion, expanding plant and equipment and hiring. But I think it's a very important point in these fairly unsettled times is corporate Canada, corporate US, and corporate Europe is very strong. The big issues of anxiety rest with households in the US and with governments in the US and with Europe.
Right. So Chris and I often talk about various things that retail investors should be looking at, and I wanted to get your perspective on what some of these macro indicators are that Canadian stock and bond investors in particular should be watching for.
Well, a lot of the volatility that we're seeing is being generated by nervousness in the U.S. Fiscal situation and also in Europe about the debt of Greece and a variety of other countries. And so you're going to see over the next little while on-again, off-again stories about these that are going to lead to market volatility. The outcome is going to reduce growth, I think, in those economies. But at the end of the day, I would expect volatility in the equity markets and probably even in the bond market. However, bearing that in mind, I think what you're going to find is that, as I said earlier, bond yields aren't going anywhere fast. They're going to remain relatively low. And on the equity performance side, slower growth and more volatile markets suggest not a whole lot of gains, I think, in the next few months.
Right. Very much appreciate you coming in and speaking with us today. Please keep your questions and comments coming. You can contact Chris and I at TwoInvestmentGuys.com. Join us next time. Chris will be back and we'll continue our discussion around all the various market dynamics that we see. So until then, I'm Grant Stephen for the Two Investment Guys.